Okay, hello everyone, and thanks for joining. People are still kind of trickling in, but it is a couple minutes after the top of the hour here, so we'll get going. First of all, thanks so much for joining. This is our first webinar, and we're planning to hold these a couple times a year. And the idea is to just sort of extend our knowledge to, the young adult family members of our clients and anyone who is a client who maybe just wants a refresher on some of the basics. So, we're going to be hosting these a couple times a year, as I mentioned, and just different topic each time. So today, what we're going to be tackling is just kind of going through these account types and explaining how they work, who's eligible to participate in them, when they make sense, when they don't make sense, and if you don't have enough money to do everything, how might you want to prioritize them? So just by way of agenda, I do want to just talk a little bit about what we're planning to do here at TIER to help to support all family members of our clients. Then there's a few definitions that I want to go through because they are relevant to understand the rest of the material that I'll be going through today. Then we're just going to get right into the different accounts and go through each one of them one by one. And then we're going to talk about prioritization, as I said. So if you can't do it all, what should you choose to do? So yeah, first of all, like this page here, it's right off of our website on tierwealth.com, and it speaks to the services that we would like to extend to our clients' younger family members. So, things like helping with their first tax returns, talking through how do you optimize your financial situation early on in your life as you're kind of getting going, one-on-one coaching on some of the conversations that we're going to have today in this meeting, and then looking after the details with respect to, disaster planning around your estate. The second bullet point there on the estate planning is one that we're really proud of here at Tier Wealth. So we have actually partnered with a will provider called willful.ca, and we've actually pre-purchased a whole pile of wills so that we can really try and encourage these younger Tier Wealth family members to get those things done because it's important at all ages. And we found that in the past, often we would talk to our clients and tell them, hey, your kids should be doing these things. And then next year later, we ask if anything happened. And, of course, nothing does because it's just hard to get it up to the top of the priority list. So we've kind of pre-purchased a bunch of these that we're planning to hand out when there's interest to really try and encourage people to get those things done. Now, an online will, perfectly valid, but of course it's only for quite simple situations, so just keep that in mind. And then, on the longer term side of things, just making sure that, you're saving in the right direction and your money is invested in a purposeful way to meet the goals and the things that you want to do. The other thing that we're doing, as I just want to highlight, is we're holding office hours each month to just kind of create a very easy way, an easy access point for, again, these younger Tier Wealth clients that they don't necessarily need to go through the whole process of scheduling a meeting. We're going to hold some time every month where you can just pop in. There's an open Teams meeting link that would take you right to one of us, and we're going to just kind of circle around at the office here, and one or two of us will be on each month. So that QR code, if you just want to take a picture of that will take you right into that Teams meeting link on these days. So it's going to be the third Friday of every month at noon Mountain Time, and the dates that we're going to hold them are outlined right there in front of you. So yeah, we'd be happy to have, just quick informal conversations. You got a question that, maybe you don't think it's worth an actual scheduling of a meeting, pop in, take 5 minutes, and we're happy to answer. So today, and this foundation tier, it is on our website. So this is just text right off of our website. So this is our first webinar that we are having. So really happy to have you all on the call today. And we're going to be holding these a couple times a year, as I mentioned. So getting into some of the definitions that are really important to understand today's conversation, there's really three. So the first is just understanding that our tax system in Canada is based off of progressive rates, and I'll explain what that is in a minute. Then we want to talk about what is your marginal tax rate and what is a tax deduction. So when you hear these words, I want you to understand what they mean because they are quite important foundational items. So now this is for Alberta, and each province is a little different because they've got their provincial tax rates that differ from one province to the next. But here in Alberta, you see that you have a lower tax rate on lower levels of income. And one of the myths out there that we do hear from time to time is, people are kind of at the cusp of one of these tax brackets and, maybe they get a raise or a bonus or something like that. And they're concerned all of a sudden that they're going to be taking home less. Well, that's not really the way it works. So how it works is on the amount that spills over into the next higher bracket, you pay a higher tax rate, but only on the amount that spills over into that next threshold. So you're never going to be in a situation where you take home less money by making more money because it's only the spillover amount. But really important principle to understand that as your level of income goes up, the amount of tax that you're paying on the higher amounts also goes up. So then let's talk about your marginal tax rate. So now at the top here, you'll see that we're kind of talking about someone who has taxable income of $50,000. So if they were just making 50, the next dollar that they earn, that's what we're talking about here when we say marginal. It's what's the tax rate going to be on the next dollar of income. So if you're making 50, you're still well within the first bracket. And so your marginal tax rate is 22%. So you make another dollar and you take home 78 cents basically because 22 goes to the government for tax. If you're making $150,000, now all of a sudden your marginal rate is 36%. So the next dollar you earn is taxed at 36, not at 22 anymore. You've moved your way through these brackets. And if you just keep on going, you'll see now this person has $350,000 of income and they're right in that 47% tax bracket. So it's not only relevant, this marginal rate, on the next dollar of income, but it's also really relevant on looking at opportunities for how do you lower the amount of tax or the amount of income that's being reported on your tax return. Because if you can take a dollar off of the tax calculation and you're at a 47% tax bracket, well, you've just saved yourself 47 cents of tax. Whereas the person in the lowest bracket, if they have a tax deduction, then like if they have one less dollar of tax on their tax return, they're only saving 22 cents. So really important to kind of understand that tax rates are progressive in nature, and your marginal rate, it matters quite a lot when it comes to planning around things like contributions into different savings accounts. So the last term I wanted to speak to is a tax deduction. So on the right-hand side of this page now, you see if someone started with $50,000 and they had a $10,000 deduction, what that means is that when they file their tax return and you run through the formula to determine how much tax you pay, that is only going to be calculated based off of $40,000 because you've had a $10,000 tax deduction. So what it does is it removes income from the top. So you can see here, their deduction is worth 22% because their marginal rate is 22%. So a $10,000 deduction is going to put $2,200 of tax savings in their pocket. On the other hand, as you move up the marginal brackets, that same $10,000 tax deduction is now worth $3,600 because they're in a higher tax bracket. And kind of at the extreme, if someone was in the top rate here in Alberta, it's a 48% tax bracket, and that deduction will save them 48%, and $10,000 equals a $4,800 tax savings. So conceptually here, the higher your marginal rate is, the more valuable tax deductions are, okay? And the other thing here that's also really important to understand, the government has certain benefits that are available to different populations, and a lot of these benefits are based off of not your total income, but your income after your tax deductions or your net income. So the one thing I think that I wanted to highlight, like for older people, this is very important for things like their old age security, which is a government pension. It's taken away as your income is higher. But for younger populations, the Canada Child Benefit is a really important thing to consider. So as you have kids, the government gives you a pile of money to start with. And then they say, we're going to start taking away some of that money as your income gets higher and higher and higher as a household. So for this, you add up both parents, if there's two, look at the total, and you figure out how much of the Canada Child Benefit will be taken away. So you can see here, this is really quite powerful because this is over and above the tax savings that you get that we spoke about here. So let's say someone, was, let's just say they're at the lowest tax bracket, 22%, but which means that they're, a lower income family. But let's say they had 3 kids. Well, now they get another 19% for every dollar of a tax deduction they get. So now you would add the 22% plus the 19%, and you're up over 40%. And that's the same effective tax rate as people that are making much, much higher levels of income. So really important here to understand that tax deductions when you have family, like, a family with young kids, especially if you have quite a few kids, tax deductions are really valuable, even if you're not bringing home a high level of employment income or anything like that. And this is all really important for deciding where you're going to put your money when you're saving. So definitely an added benefit for parents to look at accounts that give you a tax deduction. So let's get into these account types now. So there's 4 that I want to go through. I'm going to go through the first one relatively quickly, and then we're going to get into the other 3 and spend a little bit more time on that. So a non-registered account, put simply, is just your regular, plain investment account. No unique characteristics, no special tax treatments. You don't get any tax benefits for contributing money into the account. The investment income that you earn inside that account will show up on tax slips at the end of the year. So if you earn interest or dividends, or if you buy something and sell it later at a higher price, when you sell it, there's a capital gain is what that's called. All of these things, if they're happening within a non-registered or a regular investment account, they're going to end up on your tax return, and then you're going to pay income tax on the investment earnings based off of your marginal rate. I would say, as a whole, our industry does a really, really poor job of making this easy for people, because you don't only hear the name non-registered. In common practice in the world out there, you're going to hear many, many, many different names for more or less the same type of investment vehicle. And this is just, kind of a meme joke that I put together just to kind of highlight this. So these are more or less all the same. We're talking about the same thing here. So if someone says I got a regular account or, a non-registered or a cash account, some people call them taxable accounts because by nature of the way that they work, the earnings that you have are taxable. Margin, same thing again. It just means that you can borrow some money in the account if you don't have cash to buy something. You can kind of go and basically borrow money within the account to invest. But these are all more or less talking about the same thing. And I think it's really kind of frustrating because this just adds to confusion for, regular day-to-day Canadians that aren't thinking about this all the time. So it would be sure nice, I think, if there could be a little bit more consistency in the terminology that's used in the public, but there isn't. So I just wanted to highlight this so that, when you hear some of these terms, you understand that, we're really just talking about a non-registered account. And you might even ask, why is it called a non-registered? Like, what the heck does that mean? Basically, because these are just regular plain old accounts and there's no unique tax characteristics, the government doesn't require your financial institution to do, separate reporting or registration with the government. So for other account types, your financial institution has to make sure that, you're eligible to have them, that they're following the rules, all of those things. And each account that's opened then gets registered directly with the government, and they keep a listing of these types of accounts. So that's why some accounts are referred to as registered accounts and others are not. So let's get into some of these accounts that you're more likely to use earlier on in your life. So let's talk about the RRSP first. And so the first R stands for registered retirement savings plan. This account, you can only put money into it if you have had previous employment earnings. So the terminology here is earned income, and employment income is earned income. That really for most people is the main one that we're talking about here. If you're working for someone else and they give you a T4 at the end of the year that reports your employment income, that's considered earned income. The other one that comes up from time to time is if you have a second property that you're renting out, the rental income off of the property, that would be considered earned income as well. So this surprises some retirees because they've stopped working and they assume that they're not going to accrue any additional RRSP room, but they do have a rental property, and then that rental income generates new RRSP room because it's considered earned income. So you make 18%, or your contribution room grows by 18% of your, I'll just say employment income in the prior year. So let's say you, in 2025, made $100,000 at your job. Then the next year, you would be able to put in $18,000 because you've earned 18% of your $100,000 salary that you had. There are caps on this. So when you make enough money such that 18% hits $33,810 for the year 2025 income year, that's the most that you can ever accrue for RSP contribution for the next year. And that 33,810 is, it increases each year with inflation. So next year it'll be higher. Last year it was lower. But this is where we're at for this time period right now. So how does this account work? So first of all, when you put money into it, you make a contribution. You're going to get a contribution receipt that you put on your tax return, and that is going to give you a tax deduction. So as a reminder, as we just talked about, the higher your marginal tax rate is, the more tax that this is going to save you. So one other thing that I will just say, I don't have a bullet point on it in the slide here, but you can make a contribution, get that tax receipt, put it on your tax return, but then choose to not actually take that tax deduction in the year that you've made the contribution. So if you knew that you wanted to save in an RRSP, but you also knew that next year you're maybe having a kid, or you know that you're going to get a raise at your job and it's going to push you into that next higher tax rate, you might choose not to claim the tax deduction in that year and save it for, the next year or two. I would caution people on not claiming the deduction for too long, because there's value in getting money back in your pocket. So let's say you're currently at a 30% tax bracket, and you knew that 5 years down the road you're likely going to be at let's say a 45% bracket, but it's going to take you a while to get there. Would you rather have 30 cents back now or would you rather have 45 cents but not for 5 years? You have to kind of think about the time value of money in this equation and what you're going to do with that refund money in the next 5 years. Because if you could make, say, 5% on your money, let's say you had got your 30 cents back and then you made 5% per year for 5 years, you're actually going to be ahead of the game compared to waiting to claim the deduction 5 years later. So I think it makes a lot of sense here to wait on the claiming of these deductions if we're talking about a relatively short waiting period. But if it's longer and longer and longer, it starts to make less and less sense because it's that delayed gratification here. So just want to highlight that. So once you've actually put money into the account, then it's pretty sweet because you never get a tax receipt for anything that happens with the investments inside the account. Contrast that to the non-registered account, where every single year you get tax slips that report the income that you earned in the account and you have to report it. On this, that never happens. So all the buying, the selling, the interest, the dividends, all of that happens within, you never get tax receipts for it. And that allows that account to grow and grow and grow and compound without being subject to annual taxation. And that really does add up over time quite a lot. Now, what happens down the road in the future when you take money out of your account? So in this case, it's the opposite impact of putting money in. So now, let's say you're using the example I used before, $100,000. Let's say you're making $100,000, and I'll just back up. So yeah, okay, let's use the one that's on the screen here. Let's say you're making like 125,000. You're at a 36% tax bracket. Now you withdraw $1,000. Now you're not going to show $125,000 of income on your tax return. If you take an extra $1,000 out of your RSP, you're going to have to report $126,000 of income, and you're going to have another $360 to have to pay on your taxes in that year. So really, it's the opposite of a contribution. So put money in, it saves you taxes. Take money out, it adds to your income, and you have to pay taxes on that withdrawal. So the goal here really is use an RRSP when your income is high. So put money in when your income is higher, and then ultimately you want to take money out when your tax rate has fallen to a lower level. And strategically here, the idea around an RRSP is it is primarily intended to be a longer-term retirement savings account. So you're putting money in during your working years where you have your reasonable salary. And then when you stop working, all of a sudden your income falls to quite a low level. And now you're in a lower rate. so that those withdrawals that you're making down the road are taxed at low tax rates. So that's the best case scenario with an RRSP, is you're putting money in at high rates or higher rates, and taking it out at lower rates. And remember here, on the contribution side, if you do have kids, a young family, you have to consider that Canada Child Benefit when you're thinking about the current rates, because you might be in a relatively low marginal tax rate, but when you add the child benefits, it might be pushing you up into levels where now all of a sudden it does make quite a lot of sense to put money into an RRSP. But some certain types of withdrawals with RRSPs actually don't subject you to taxation. So let's just talk about that quickly, because it's important to understand how to use this account as a tool. So if you're saving up to buy a house, you don't have a house yet, you're saving up for your first home, you want to get that down payment. If you have money in your RRSP, you're allowed to take it out. You have to have a written purchase agreement. There's specific rules here that you have to abide by. But if you have an agreement to buy a home, you're a Canadian resident, you're living in Canada, all these things check out. You can take up to $60,000 out of your RRSP, and you don't have to report it as income on your tax return. Now, the catch here is that you do ultimately have to put the money back into your RRSP. And if you don't repay the amounts according to the schedule that you receive, then there's a little bit of that withdrawal that comes into your tax return as income if you've kind of failed to meet the requirements. Not the full amount, but just a portion of it that relates to each year. And I'll show you a schedule of how this works in a minute. The other thing here to be mindful of is this really is not intended to be like a short thing. So you have to have money in your RRSP for at least 90 days before you can use the home buyer's plan. So don't leave this for the last minute. If you know you're buying a home and you know you want to use the home buyer's plan, you have to have the money in the account and have it sitting there for at least 90 days before you're eligible to use this program. So don't leave it for the last minute. The other area where you can access money from your RRSP without being taxed on it at that time is a program called the Lifelong Learning Plan. So this is for people who are funding their education. So it's got to be a full-time program, so your university years would count. If you're out of university or doing some kind of continuing education program like an MBA, or there's a lot of different things that you could use for this. Tech schools, any of those kinds of things would be okay here. You can take up to $10,000 per year out to fund your tuition or books or whatever without it being taxed as well. And you can do it a couple years in a row. You just have to stay within $20,000 total. So you could do, $5,000 a year for 4 years, that kind of thing. And you can use this plan multiple times in your life, so long as you have repaid the entire balance outstanding before you go to use it again down the road. So conceptually, you could use it for university, and then later on in your career, you could use it again for some kind of an upgrade. The repayment timelines for the home buyer's plan, I don't think I mentioned this, is a 15-year repayment timeline, but it doesn't start immediately. You get a bit of a grace period before you have to start making those repayments. And with the lifelong learning plan, it's a 10-year repayment timeline. So a little bit shorter window here that you need to take them, that you have to repay the money, but the dollar amounts here are a little lower too. Same thing here with the lifelong learning plan with the 90 days that you need to have the money in the account for. So I'll just take my face off for a second. So this just kind of shows you side by side how these two programs work. So let's assume someone took out the full $60,000 from their RSP to buy a home through the home buyer's plan. As you can see, there's no requirement to make a repayment the next year But the year after that, so if you're talking about a withdrawal in 2026, you'd have to start making repayments into your RRSP in 2028, and the amount is that 1/15th. So it is a 15-year repayment timeline once the required, once that first year occurs. And let's say you didn't make the contribution back into your RRSP in 2028, what would happen is you'd be taxed on $4,000. So you didn't get taxed on the original withdrawal, but then that 1/15th amount would become taxable if you failed to put money back into your RRSP according to schedule. And if you, let's say you could only put in $2,000, then you'd only be taxed on the remaining $2,000 that you didn't satisfy on the repayment timeline. And then on the lifelong learning plan, very similar idea here. So let's say someone took out the $10,000 that they're able to in 2026. The timeline here before you have to first start putting money in, it's longer. The idea here being, you might be taking money out to go to university, and it might be a 4-year program, and you're not going to have income for 4 years potentially. So they give you a longer grace period here before you need to start putting money back in. But all the other things that I mentioned about the income inclusion, if you don't meet your targets on the repayments, is the same here as it is with the home buyers plan. So last thing I wanted to mention on RRSPs is that if you do have a spouse, there's some kind of family planning that you can do regarding which person you're accumulating savings for. So a spousal RRSP is kind of a cool tool, because what it does is it allows the person who makes the contribution. So I'm married, I've got a wife at home. So let's say we had a spousal RRSP for her, which in reality, we do have a spousal RRSP for her. Her name's Miranda. So I would make a contribution using my personal contribution room into an account that's in her name. So I get the tax savings now, not her. In the future, when withdrawals are made, I'm not taxed on them, she is. So it's a pretty cool tool to allow you to, especially in families where you have one spouse that's making more money than the other, or maybe even age differences. Like if one person is older and you know that they're going to be retiring sooner, then maybe a spousal RRSP there makes sense, because in their earlier retirement years, when you're still working, they can take money out and be taxed on it, and you won't be. The other thing, obvious thing here is just if you have, like say, a stay-at-home parent, they don't have their own income, so getting some future income that'll be taxed to them and not to you is going to be pretty attractive here. Now, there is a catch. Again, a lot of these rules kind of have restrictions on timing. So if I were to make a spousal RRSP contribution right now in 2026, if a withdrawal was then made out of that account prior to 2029, then I would actually be taxed on the withdrawal, not my wife, even though the account is in her name. So it's it's called attribution technically here. The withdrawal attributes back to the person who put the money in if the withdrawal happens in a relatively short period of time. And the technicalities on this, it's not really 3 years from the date of contribution, even though everyone refers to this as the 3-year rule. What it is it's the year in which you make your contribution plus the last 2 calendar years. So if I was making a contribution, let's say in December, then the 3-year rule is really only a 2-year plus a month rule, even though it covers off 3 different calendar years. Okay. So now let's talk about the tax-free savings account, the TFSA. So for this account, you need to be 18 years old and a resident of Canada to have one. Some provinces, age of majority is actually 19. So like BC, our neighbors, it's 19 is the age of majority for them. So an 18-year-old in BC couldn't go to a bank and open an account because they're not of legal age to sign contracts yet. So you have to, realistically, you have to be considered age of majority. In Alberta here, it's 18. You have to be a resident of Canada. Importantly, when you put money into this account, it does nothing for your tax return itself in that year. Whereas with the RRSP, you got that tax deduction that gave you a refund or it lowered, the amount of tax on your tax return. This one doesn't work that way. So you're essentially paying your tax on your employment income. You're getting money into your bank account. That's tax paid money. You've already paid tax on it. And then you're putting it into this account. Now, once the money's in the account, it's like an RSP kind of, there's no annual reporting of any of the investment income that happens inside the TFSA. No tax slips will be given to you for any of the investment activity. And it's allowed, therefore, to grow and grow and compound without being subject to tax, which is a pretty sweet deal. Now, the real nice thing about this account is that the money grows into hopefully a very large, significant amount over many years. And then when you actually need to spend the money and you make a withdrawal, there's nothing that shows up on your tax return now either. The withdrawals are completely tax-free. So it's no front-end tax benefits, money grows without taxation. You need to spend something, you make a withdrawal, no big deal, doesn't do anything, and it's completely tax-free kind of the whole way through. So really operates quite a lot differently on the ins and the outs compared to an RRSP, but a really powerful long-term savings tool because of the fact that it truly, everything that you earn in there is a tax-free gain. Now, I'm going to back up a second because you'll see the second bullet point here must be 18 and resident of Canada. The RRSP actually is the only investment account where a minor can have that account. So if you were, let's say, like you're 15, 16 years old, you have a job, you get earned income, even as a minor, you can have an RRSP. Now, you can't actually sign the account opening paperwork, so you need to have a parent or a guardian or someone that's allowed to sign on your behalf to assist you in this process. But if you did have that employment income as a teenager, you can get a head start on your savings using an RRSP, but that is not an option with a tax-free savings account. You have to be 18. So another thing that's different here with this account, remember with an RRSP, you earned the ability to contribute into it based off your earnings, your employment income. That's not how this works on the TFSA. So with this one, as long as you're 18 and you're a Canadian resident, you earn the contribution room, just like everyone else who's at least 18 and a resident of Canada. You don't need to have the account open to do that. And the amount that you put in is determined on an annual basis. So when this account was first launched back in 2009, you could put in $5,000 per year. Now that's increased with inflation up to $7,000 per year. And they kind of track this, the government does, and they only increase the annual new room by $500 increments when inflation, might take a few years to get to the next $500 hurdle. But then when that happens, you all of a sudden get to put in a little bit more than you did in the past. And if you're not making your contributions, your room just accumulates. So if you had, I guess a lot of what I'm saying here is on this slide. So if you were at least 18 years old when the TFSA first was launched, and you've never opened an account, your lifetime contribution now, adding up all the different years in total, would be $109,000. And yeah, just as an item of note, so I had a meeting with a client just a week or two ago, and they have diligently saved in TFSAs. There's two of them, husband and wife, since 2009, and in their accounts, they've had it invested relatively aggressively because they had other money that was invested more safely, and they've kind of designed this so that they gave the TFSA the most opportunity as they could. And between the two of them now, they had $650,000 in TFSAs. So you think about that, like they've put in, just shy of 220,000, and now it's 650, and all the gains there are completely tax-free. So that just shows how powerful this account can be. And we're only talking about, $5,000, $6,000, $7,000 a year. But the compounding opportunities that are available here are really, really powerful. So if you can make it work, really recommend you try and get this account topped up as best you can. And it works really well for people who are not at high levels of income yet, because we don't care so much about the tax deduction that you would get on an RRSP at the front end. So this is a really attractive long-term savings account. The other thing that's really nice about this account is just it's highly flexible. So if you make a withdrawal here, sure, it's not taxed, but then that actually adds to your contribution limit for the next year. So what I mean by this is you can use this for shorter term needs. If you put money in, something comes up, you need to take money out. You don't burn your contribution room forever by making a withdrawal. Come January of the next year, you're going to get the new room for that next year, plus dollar for dollar any amounts that you had withdrawn in the prior year. So, it's just a really flexible account. And whereas with the RRSP, if you make a withdrawal, you don't get your contribution back in. It's kind of like you burn it, you burn your room and you're done. So sorry for flipping back and forth. I just want to point this out because almost every place that you look on the internet that talks about contribution limits is going to talk about this lifetime amount of $109,000. But for you guys who are on the call today, like you weren't 18 yet in 2009. Some of you, maybe you weren't even born yet in 2009. So who cares about 109,000? So that's why we put together this page right here. This shows you, if you look at the top, all these different birth years and ages that you might potentially be. And you can see how your personal contribution room may have grown over those years. So let's just pick a year. Let's say you're 24 years old, you're born in 2002. Your first year of eligibility would have been the year 2020. And in that year, the limit was 6,000. So you would have had 666, 65, 777 for 45,500 total. For the youngest people out there who were born in 2008, they're 18 now. Finally, you can open a TFSA, but you can only put in $7,000. So just be careful here about how much you're putting in, because if you're reading some of the material out there about lifetime amounts, it's only talking about people who were born in 1991 or earlier, okay? And that would put them at age 35 or higher today. So the last account I want to talk about today is the First Home Savings Account. This is a relatively new account in the Canadian marketplace. First year was 2023. This is a phenomenal savings account for people who are saving to buy their first home. It marries the best features of both of an RRSP and a tax-free savings account. Like a TFSA, you have to be at least 18. You have to be a resident of Canada. You can't already own a home that you're living in. So you have to be considered what they call a first-time home buyer. Now, it's it's an interesting term because it doesn't technically actually mean that you have never owned a home. You could have, and you might still be eligible for this, but you are not able to have personally lived in a home that you owned in the current year or any of the last 4 years. So, I mean, limited, I think, real life scenarios here, but let's say someone bought a rental property, but they never lived in it. That's okay. You can have a rental and you're still considered a first-time home buyer because you were not personally living in that home. Maybe you're a little older and you had a home that you were personally living in, but you sold it 6 years ago. Now all of a sudden enough time has passed that you're considered a first-time home buyer again, and you're eligible for a first home savings account. So just kind of wanted to point that out because the term first home is a little bit of a misnomer. So let's talk about these features. As I said, it's the best of both worlds. So contributions going in give you a tax deduction just like an RRSP. The investments grow without annual taxation, like both an RRSP and a TFSA. So it allows you to have your money compounding without tax. But then if you buy a house and you make a withdrawal, the withdrawals are tax-free, just like a tax-free savings account withdrawal. So you get the tax benefits going in, which allows you to save larger amounts sooner, and then the money coming out, whatever the account grows into. So let's say you put in $40,000 and over 10 years it grows into $200,000. The full $200,000 can come out tax-free to be used against a home purchase. So really, really kind of a sweet deal here. But let's talk about the account lifespan. So if you, or actually, let me back up one point here. So let's say you use a first home savings account, but then something comes up and you need to make a withdrawal before you've been able to buy a house. Because you don't have a home purchase agreement, the withdrawals then become taxable. So in that case, it works just like an RRSP. You really have to use this account for the intended purpose for it to really work the way it's supposed to. So I just want to highlight that. The account has a narrow timeline. So from the year that you open it, it can only stay open for 15 years. So that comes into play sometimes with people where, in particular, if you live in an area that has really high cost of housing, like let's say you're in Vancouver or Toronto or something like that, even in Calgary's, the prices have gone up over the last 5 years here too. Let's say you're just not confident. Let's say you're 18 now. You're just not confident that you'll be in a position to be able to buy a house in 15 years. Maybe you wait a little while before you open the account because the clock starts ticking once you open it. So can be a consideration. I think for most people that are diligent and are even thinking about savings, 15 years is a long time. So I would encourage most people to go ahead and open it if you think you can fund it. But let's talk about the scenario where the 15 years pass and you haven't bought a house yet. The account needs to be closed. If you just take that money back to your bank account, it is fully taxable, just like an RSP withdrawal would be. But here's kind of the saving grace. You have the option at that point or at any time in between to transfer money from your first home savings account into an RRSP. That's not a taxable event. And then from that point forward, it just works like an RRSP works. So you can save it until you're retired and then take the money out way down the road. So it's a pretty good backup plan, I would say. Even for people that never want to actually buy a house, they probably should have a first home savings account if they're maxed out on their RRSP, because in a nutshell, this would allow them to get more money into their RRSP that is beyond the contribution limits that are, based off of employment income for RSP contributions. So kind of a cool tool here. How much can you put into it? So $40,000 in total is the maximum, and it has to go in no greater than $8,000 per year. I guess, so it's $8,000 of contribution room per year. If you didn't put in the full $8,000, let's say last year you had an account and you put in $6,000, this year you could put in the $8,000 for this year, plus the extra $2,000 that you didn't put in last year. So you could put in 10 this year if you only put in 6 last year. The maximum carry forward amount there is 8,000. So you would never see a scenario like, let's say you opened an account in 2024, you didn't put anything in, you didn't put anything in 25. Here in 2026, you might say, can I put in 24,000? No, you can only put in 16 because the maximum carry forward is capped at $8,000. But here's another kicker. So the middle point here, I kind of skipped it. So let's think back to a TFSA. You start accumulating contribution room on your 18th birthday, and you don't need an account. And then maybe 10 years later, you open an account and you've got many, many years of contribution room that you can dump in as a lump sum if you were able to. With this account, it doesn't work that way. So you only get the contribution room once you've actually opened an account. So the planning point here would be, let's say you knew that you were saving up for a home, got a relatively short time period, but today you don't have the money to contribute. Let's say you're in an arrangement where you get a bonus in the spring. You might be thinking, I'm going to put that bonus in my first home savings account. And maybe your bonus is like, let's say it's like $30,000 or 20 or whatever. I would strongly encourage you to open an account in the prior year. So like get it opened in December before the end of the year, because then you're going to get the contribution carry forward from this year. You add it to next year's amount. And then when you get your bonus in the spring, because you had the account already opened the prior year, you can put in 16,000. You're not limited to the 8. So important thing to understand here, you only accumulate the room once you have the account opened. So let's take a last few minutes here just to talk about when you might use one. I've covered a bunch of this as I've gone through this, but RSP versus TFSA, kind of the classic one here. So use your TFSA when your income is lower, use your RRSP when your income is higher, because the relative benefit of tax deductions against higher marginal tax rates. If you're thinking that you're going to be making more in the future, and all of this is kind of under the idea that you don't have enough money to do everything. So if you got to pick and choose, how do you pick and choose? So if you think you're going to get a raise and move into a higher tax bracket in the future, maybe you put your money in a TFSA today, and then a couple of years down the road, when you are in that higher income bracket or tax bracket, you could take money out of your TFSA and put it into your RSP at that point. That works out quite well because of how flexible TFSA withdrawals are. And then you could, in the future, when you're able, put money back into your TFSA because you reaccumulate that contribution room when you make a withdrawal. Going the other direction does not work. So don't put money in your RSP today, thinking that a couple years from now, you might want to put it in a TFSA, because you burn your contribution room and the withdrawal becomes taxable out of an RSP. The other thing is, if you're sitting here and you're planning to have kids, once you have those kids, the RSP contributions will be worth more in the future. So just a reminder that the family planning here is important as well. Other things. So what are you saving for? So if you're saving for education or a home purchase, the RRSP is going to allow you to build up a larger amount of savings quicker, because you can get that tax deduction, and that creates basically more money that you can invest. So if the time is a concern for building up a certain dollar amount of down payment, RRSP wins versus TFSAs, and then you use the home buyer's plan here. If you need your money to be flexible, then let's say you're saving for a car or some other kind of expense, and you're going to need it in the future, TFSA wins here because of how flexible it is. So for most cases, the RRSP should be viewed as a longer term savings account. The TFSA has greater flexibility in the short term. And then, if as a lot of people who are younger are thinking about saving up for a home, how would you prioritize all of these accounts? The FHSA by far is the first account that you should be saving in. Once you have that, if the speed is a concern, then the RRSP makes the next most amount of sense. And then if you got those topped up, the TFSA is great. It's still a really good plan. And some people ask, can I use both the home buyer's plan from the RRSP and the FHSA on the same house purchase? Yes, you can. You can double them up. And if you're in a common law partner relationship or you're married, both of you are able to use all these accounts combined. So, there's quite a lot of savings that couples can accumulate on a combined basis. Okay, so we have just a few more questions. I don't, or minutes here, not a lot of time. So if there are any questions,